Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so as all of you know, the housing market's gotten a lot crazy in the last couple of months. It's been very volatile. And volatility is not something that we're used to in the housing market. But what's very interesting is that mortgage rates have actually gone below 5%. The 30-year fix has gone below 5%. And so we're going to go through all the numbers. And then we're going to talk about why this is happening and maybe how you can use this information in the future. Okay, so Freddie Mac, who basically tracks all the mortgage products out there, they found that the 30-year fixed, the 15-year fixed, and the 5-year ARM are all much lower than they were over the last few months.
Right.
Okay. Specifically, we'll start with the 30-year fixed. 30-year fixed mortgage average 4.99%. So it is under 5. With an average of 0.8 point as of August 4th, 2022, down from last week when it averaged 5.3%. A year ago this time, the 30-year fixed rate mortgage was 2.77, so it was much lower a year ago. It was at 5.8, was a month or two ago. It was much higher.
Right.
Okay. Do you think this psychologically is going to make a difference?
So I think it's kind of funny that they came out and they said it's 4.99. I'm like, okay, that's just like right under 5, that whole, 0.99 psychological thing.
Yeah.
But okay, we'll just go with their numbers. But yes, I mean, from a psychological point of view, I think it's significant because now people are saying, well, it's 4 and change and it's gone down. So maybe we've seen the worst of it, or we've been through the worst of it, or we're going to kind of teeter a little bit, but we're not going to go to 7%, which is what was really anticipated.
Right. It was anticipated it would be a lot higher. So then the 15-year fixed mortgage numbers, 4.26. Now, this is the average. So what Freddie Mac does is they track every loan product out there. They have all the data. And every week they come out with this. It averaged 4.26%. With an average 0.6 point, down from last week when averaged 4.58%. A year ago at this time, it was 2.1, which was obviously probably historically the lowest it's ever been. But this was still much lower. The 15 was about 5 a month ago. Now, last week it was almost 4.6. So you could see how volatile interest rates are. If you locked a week ago, you were better off locking today because you just saved yourself 0.3 points. So let's talk about this. Why would you pick we're just talking about the 30-year fixed versus the 15-year fixed. Why is the 15-year fixed 4.26%? And does that mean your payment will be less?
Okay, so 2 things. One, traditionally the 30-year is a higher interest rate. The 15-year is a lower interest rate. But over the last couple of months, they've been much closer together.
Okay.
So the fact that they're spreading apart again, that's a good thing.
That's a very good thing.
That's a very good thing.
Yep.
Now, so why would you choose a 15 over a 30 or vice versa? So my thought is this. Regardless of which interest rate you're getting, the thing to really focus on when you're getting a loan is usually the payment, right?
Yeah.
So what you can do is, and we've done videos on this, you can get a 30-year loan because that gives you a lower payment because that loan is now amortized over 30 years. And then you can make the 15-year payment if you can afford that and then pay off your loan faster. Now, I recognize that it's at a higher interest rate, but this gives you flexibility regarding your budget. Okay. Now, if you can afford the 15-year easily, then great, go for the 15-year loan and bully for you. But a lot of people are kind of hemming and hawing, and I always think that you should go for the 30, but make the 15-year payment so that you're in control of paying the house off early if that's what you want. But if you have unexpected expenses, something unforeseen happens, then you have that lower payment that you actually have to make, not the higher payment that you choose to make.
Okay, so those 2 products, 50-year and a 30-year and a 15-year, 30-year higher interest rate, 15-year lower interest rate, but a higher payment because it's amortized over less years. So each time you make a payment, it's not more interest. It's more principal reduction. You're reducing the principal faster, which is why they give you a lower rate, because you're getting out of territory where you may have problems later down the road, like not having enough equity. That's the whole reason, right?
Well, plus remember, they're getting their money back faster. So the faster they get their money back, the faster that they can loan it back out and make more money.
Okay, 5-year Treasury indexed hybrid ARM. So this is Treasury indexed. It's fixed for 5 years, and then after 5 years, it adjusts. So you'd be fixed for 5 years. 4.25% with an average of 0.3 point, down from last week. I just want to point this out. When they say with an average 0.3 point, that's the money up front you have to put to buy that rate.
Right.
So if you put down 0.8 point, you may get 4.125% or something. If you don't put anything down, like buying down the rate, you may get 4.3% or something. That's just they're just giving you the number based on what the average rate is and what the average person is doing to buy that rate. Okay, 4.26 for 15-year. Why would you even do the 5-year ARM at 4.25% when you could just go get a 15-year at the same interest rate?
So that's a great question.
All right.
So the 15-year is at 4.26. The 5-year ARM is at 4.25. However, the thing to keep in mind about the 5-year ARM is that it's amortized over 30 years.
Okay.
So it's amortized over 30 years, so your payment's lower. So now think of it this way. For 5 years, your payment is amortized over 30 years, just like your 30-year loan is, but it's at almost 3/4 of a point lower. So that may make more sense. The other reason why it may make more sense to go with that 5-year ARM is that interest rates may drop again, and you may be refinancing anyway.
In 5 years.
Within 5 years.
Yeah.
And you may be refinancing anyway, and that makes a lot of sense. So when I first looked at that, I went, wait a minute, the ARM and the 50-year are basically the same. But yeah, they are. But you can see why. You can see that between these three loan products, there's a place for everybody, right? The 30-year might work better for you. The 5-year might work better. So everybody's situation is different. But kind of keep in mind what those payments are. So the payments for the 30-year and for the 5-year ARM are amortized over 30 years, and the payment of the 15-year is amortized over 15 years. So you're paying more principal on that 15-year. So that's the reason why your payments are going to be higher.
So with all these products, the 5-year ARM would be the lowest payment, then the 30-year fixed, then the 15-year, even though the interest rates don't go that way. It's because of how they're amortized.
Exactly.
Okay, so why is this happening? People are probably asking. So the last Fed meeting, they raised rates 0.75, but interest rates actually have gone down since then. Okay? What happened in the marketplace, or what forward-looking information has happened to cause all this belief interest rates were probably, like inflation's under control? Like, what is going on out there?
Right. So we've had manufacturing cut down on production. We've had, because they've built up inventory, so there's not quite as much demand for goods and services.
Okay.
And so the latest inflation numbers were much lower than expected.
Yeah, energy prices are down. A bunch of things, costs are down. Shockingly so, there was one forward estimate I saw that said the July numbers that come out would be like around 3.2%. And it was monthly, and that was the 9.1 was the monthly average annual rate. That's if it was that much inflation over a whole year, it'd be 9%. And then the July so that's the July numbers. The August numbers will come out in September, and then the Fed will meet again. So the belief is that if the interest rates, if the inflation rates are kind of back to kind of normal for 2 months in a row, the Fed may not just keep slamming these massive increases, and that'll affect 10-year treasuries, the mortgage markets. Remember, they're competitive, so they're trying to sharpshoot this, just like people sharpshoot the stock market, right? So that's why we saw the Fed raise rates, but we're seeing mortgage rates starting to go down again.
Right. So a couple more things to keep in mind. The Fed met, just recently, but they won't meet again until September. They're taking August off.
Everybody does.
So that's part of kind of what's baked in this is that we're going to have stability at least until September, until the Fed meets again. And then the Europeans are starting to take action against inflation too. For example, Bank of England, they just raised interest rates too. So there's a more a wider effort by multiple actors to rein inflation. And all of this plays into what we're seeing in the mortgage market. Plus, like Todd said, the mortgage market has looked at this, months ago and kind of baked it all in. And so now that we're starting to get some positive news, that's part of the reason why we're seeing some breaks for buyers as far as the interest rates.
Okay, inventory starting to rise. We're almost, in Vegas at least, we're almost at where we should be for a normal market. Okay, we're not quite there, but we're rapidly going back that number. Potentially go above the number to higher than like what's normal. Interest rates going back down, you're going to have two things possibly happen. Buyers are going to not have to fight for a house. They'll be able to go there.
That's already happening.
It's already happening.
So buyers are not facing multiple offers as often. They are still facing multiple offers, just not as often.
Right.
Buyers are not having to waive inspections, appraisal, all that stuff. It's a much more normal market. It's a much more fair market, I think.
Yeah, definitely.
Because it's not so one-sided.
Do you think that people seeing interest rates going down, I mean, obviously there are loan officers calling people going, hey, I can get you a 4.25% 15-year or 4.25%, 5-year ARM. We can go get a house. There's a bunch on the market, call your A. This information is getting out because these numbers literally just like these are brand new numbers. They just came out from Freddie Mac. Do you think that possibly gets some people back in to because right now what we're seeing is a lot of cash offers still. Right.
There's still a lot of cash offers. So, and which is normal, especially if you're sitting on cash and you're looking at inflation, you're looking at rising interest rates, then why not put your cash to work and try to hedge inflation and not have to pay higher interest rates? So that makes sense.
Okay. All right. So this is actually great for the real estate market. The doom and gloomers have been pumping fear. There's a good probability that a lot of the purchasing in the last year was FOMO. And that a lot of the lack of purchasing and people trying to list their homes are two things. There are people pumping fear and scaring people. And then there are people pumping the fear are trying to get listings, right? They're like, sell your house before the market's already crashed 40%. Sell your house immediately. Right. And it's like, huh?
So there are a couple of things to keep in mind. We do have a lot of listings coming on the market. So, and these listings fall into several categories. One of the categories is, oops, the train is leaving the station and I want to still sell my house. So I'm going to try to sell my house now. But a lot of these people who are going to try to sell their house now, they may not sell their house because they can't get whatever magic number that they're looking for. And if they can't get that magic number, then they're going to pull the house back off the market. Okay, because remember, they've got a low interest rate and they don't actually have to sell. And as far as buyers are concerned, buyers are going to have their pick of houses, which is good. And the houses that are, I call them pretty houses, the houses that are pretty and in good condition, they're going to sell. The houses that are less pretty and not in good condition, they're not going to sell. And so those houses are going to be taken off the market. So you're going to have two sets of houses being taken off the market. The houses that are not priced per the market and the houses that are not in good condition. So those two sets of houses will come on the market and they will be pulled from the market. So they will not sell. So the houses that will sell are going to be the houses that are in good condition and that are priced in keeping with the market.
Yeah, this is not a market where people are forced to sell.
Right.
Oh my gosh, I have to sell. Right. This is not. It's backed by cash. It's backed by low interest rates.
Well, the other
no one has to sell. People are, choosing to sell because they believe, they heard they can buy the house back 40% less next year.
Right.
Right.
The other thing to keep in mind that this is not the kind of market that you want to go fishing in if you're the seller. Meaning, list high and then we'll see if we can get somebody who doesn't know what's going on in the market. Nobody is out there looking for a house to buy and doesn't know what's happening in the market. Please, list your house appropriately, okay? You're just hurting yourself.
Something very interesting tangentially that I read today, I was trying to find the article here when I was talking. One of the casino groups, it was either MGM or Caesars, just came out with their quarterly numbers, blew the doors off, highest quarter ever. More people are coming to Vegas spending money than ever before. These casinos are not laying off, they're all hiring. We are in a entertainment boom here in Vegas. It's crazy out there. Of course, if you try to get on, try to buy a ticket on a Friday to Vegas, and the flights are already super full. And Vegas is doing very well economically. And of course, we have wage growth here and everything. So prices are definitely frothy over the last 2 years of appreciation. So that's why, we have these, it's very difficult to predict the market because you have these great things happening, which are, we have super low unemployment, we have super high tourism here, interest rates are starting to go down now. But then we have these other things happening, which are, interest rates are more than they were last year, even though they're going down. And then inventory is going up, and where's that going to stop? And of course, in any real estate transaction, it potentially is always good for one side. A year ago, it was great if you were the seller. It's probably, over the next few months at least, going to be great if you're a buyer. You will have multiple houses to look at. You'll be able to put in offers without, potentially having to of course, if it's a smoking deal, there'll be multiple offers on it. And so we're just focused on numbers that, we understand that we can make sense of, and not trying to scare everybody, because that doesn't really do anything.
Look, we're here to give you information. We're not here to pump things one way or another. We're just here to give kind of a balanced view of what's happening in the market. Yes, inventory is up. Yes, inventory is going to continue to go up. Yes, there are price reductions. Price reductions will continue because it's that kind, like we've said before, it's the time of year, it's the kind of market. So there are a lot of things at play. Not only that, but it's the midterm election in a couple months coming up. So there are a lot of things going on. There's a lot of fear-mongering out there. And the bottom line is real estate is the long game. So whatever you're doing, it has to make sense for you, for your particular situation, and for what you're trying to accomplish. Like I always say, everybody needs a roof over their head. So if you need a roof over your head, you're generally better off buying rather than renting, because whether you're buying or renting, you're still making somebody's mortgage payment, so you may as well make your own. Yeah.
We're going to keep an eye on interest rates as they change, and so you guys know what's going on out there. 4.25% is still historically extremely low. If you were to look back over the last 30 years, there probably have only been 6 or 7 years of 30 where you could get a 4.25% mortgage rate. So these, this thoughts that this might crash the housing market or do whatever, in Vegas, economics are not driving the housing market to slow down. Fear is driving it right now. There's a lot of fear. There's a lot of people saying, I'm going to wait a year because somebody told me prices would go down 40%. And if you find yourself next year having paid another, $30,000 in rent and not been paying off a mortgage, and you end up buying a house for what you could have bought it today for, just something to think about. We don't know what's going to happen with home prices. They could go up, they could go down, they could go sideways. They've been going up for the last couple of years, but we'll keep an eye on it. If you have a house to sell in Las Vegas, that's what we do. We work for the seller as listing agents. Just reach out to us. And what else?
So please subscribe, hit the notification bell, share the video, like the video, and leave us a note. Tell us what's happening in your market. What are your experiences? We like to hear from you. We do read all your comments. We respond to as many as possible, and we appreciate you watching our channel.
All right. See you on the next video.
Bye.
Bye.